some option-related questions. You know, in that regard, whether there's options, stocks, futures, even some currency questions out there, fire away. We are here to answer some of your questions. And, of course, you can give us a call, 877-927-6648. By the way, also, if you're over in the Tiger Den today, you're chatting in over here, feel free to chat in with me. And if you haven't noticed, my chat name apparently today is Tom. Yeah, no, this is Don Kaufman, but I'm over in the Chicago offices out here today. So normally I reside in Scottsdale, Arizona. I'm actually here doing a conference out here in Chicago, so I guess it's a nice break from 112-degree weather of Scottsdale, Arizona. But in any regard, feel free to chat in your questions as well. And, hey, we'll go over a quick review of the markets, but fire in your questions. Again, the number is 877-927-6648. If you've got a stock and you're thinking about putting some type of a trade on, whether it be bullish, bearish, neutral, maybe you're not even sure. Maybe you want to learn how to sell puts to get long stock. Anything goes. You want to talk about some criteria, some trade criteria out there, feel free to give us a call, because again, that's what this show is about. Not too interesting to listen to me for the next hour, but yeah, fire in your questions as we go along here today. With that, let's give kind of a quick recap of the markets. I am displaying, of course, on Tiger TV, so if you got my screen show up, you can kind of follow along with me. ES futures, E-mini S&P 500 futures up 1450. It's a big rally of a day. NASDAQ futures up over 40 and a half on the day. And I got to tell you, I say that, and you know, I'm kind of like grinning while saying it here a little bit. It's more of a grimace. You know, I happen to be short a couple of NASDAQ futures over here to protect another position. So with the NASDAQ futures up 40, ooh, that's kind of sore a little bit here. Now, then we get Dow futures up 95. So obviously the strongest of the indices today, of course, is the NASDAQ over here. The VIX, S&P 500 Volatility Index, down $1.66 on the day. The euro, you know, really nothing big going on here. And one thing that's kind of interesting to me that I'm looking at today, and again, I'm not that much of a market technician. I might be displaying a chart right now on my ThinkorSwim platform here. But the reality is, again, I'm not much of a market technician. I'm a little bit more of a tape reader, and I'm kind of reading between the lines here right now, and ultimately when I take a look at this, the bonds are really, you know, comparison to the marketplace. You see the market rally, normally you'd see in a market rally the bonds doing the inverse, meaning the bonds are selling off. Now, the VIX is down considerably here, and we've talked a lot about the VIX here the last couple of weeks. The VIX might not be as accurate as an indication of fear as it possibly used to be. On a day-to-day basis, I do take a look at the VIX, but one thing I do look heavily at throughout trading days is, of course, these bond markets. And the bond markets have typically been functioning where, of course, there's fear in the marketplace. Let's say the S&P 500 was selling off. You get a flight to quality or a flight to bonds. And the inverse is true. When you get a big rally like we're seeing today, you normally see a flight out of bonds into, for example, the S&P 500. Now, if you take a look at bonds today, you know, they're off on the day, meaning they're down a little bit. But in a huge rally like this, you have tendency to see these bonds, they should be really selling off a bit more than they are. So for the most part, what we're seeing is a rally today, but it's definitely kind of a what I would call a guarded rally in that, listen, money right now is not flowing from bonds. Obviously, there's a little bit of fear surrounding, you know, a press conference with Ben Bernanke tomorrow, and, you know, that could definitely have an effect on the bond markets. Who knows what he's going to talk about tomorrow? QE2 ending. QE3 is still a possibility. Anything's a possibility right now with the Fed. Anyway, with that, oil off very slightly on the day. Other things we're watching, obviously, Apple's been getting crushed down last couple of days, is back up today. It's got a little bit of a rally going, up about $8.60. With that, you know, I'm going to start jumping into a couple of the callers here. I'll be talking about the markets throughout this session here on the Option Hour, but I encourage you, if you've got questions, even if you think you've got questions, give us a call, 877-927-6648. By the way, last week we started a trend last week. It was call in and talk to us about some of the most horrific trades you've ever been in. Why? Because it's kind of amusing. And you know what? People learn from losing trades out there. So seriously, call in. We'll exploit you live on the air during the option hour here on TFNN about how horrible your trade has been. But it definitely makes for an interesting session. So feel free to call in also and talk about some of your trades. Anyway, with that, again, give us a call, 877-927-6648. I am going to jump to our first caller. We have Mike in, looks like St. Paul, Minnesota. You there, Mike?
Yeah, Don, how are you?
Good. How's it going?
Good. Hey, Don, I just joined ThinkorSwim, and I wanted to learn about as much as I could about the verticals and the Greeks.
Sure.
But I go to your spread book where you can get some ideas on what other people are doing, but I know that that's the larger piece of their puzzle. I kind of want to get a footing on, if I'm bearish or bullish, which way to go.
Sure. You know what? So I'll give you some good starting places. By the way, you mentioned the spread book. I got to tell you, from my own, seat here, that's like one of the best places to be able to find trades. So you go under Scan tab, you go to Spread Book, but then there's also the ISE Spread Book. The ISE is obviously one of the exchanges. Now, the spread book, where it just says spread book, that's our internal spread book here at ThinkorSwim. That means every trade that is sent through ThinkorSwim. Now, these are trades that have been placed but have not yet filled. They're basically sitting on an exchange floor waiting to get filled. And a lot of the times people are like, oh, no, man, those are not good trades. Those are just sitting out there. Some of the best orders are ones that are priced right and do sit out there throughout the day. So our internal spread book is really good. The ISE spread book is phenomenal because it's a spread book of literally the entire exchange, not just including, ThinkorSwim or TD Ameritrade's, brokerage book, but literally everybody that goes to the ICE. So, it's an interesting place to start searching for trades. Now, to kind of back up. Yeah, go ahead.
Yeah, say I like a certain trade on the spread book and I pull it up and I want to ask more detail, is there a support, at ThinkorSwim that I can call and kind of, pick somebody's mind about it?
Well, you know what? You can always talk to the guys at ThinkorSwim on the trade desk, and they'll definitely give you some feedback. Am I setting this trade up right? But they're probably not going to give you, the dissertation on if this is the right trade, specifically for you. We can definitely go through if they're setting it up right. But that's what I'm going to do with you right now, is try to give you some criteria in regards to these trades. And I'm also going to give you a couple of places to go look. Directly on ThinkorSwim's website. So you go to thinkorswim.com. You go under support, under thinkorswim.com. We have something called a chat archive. And years past, we did tons of Wednesday chats and just, chats all the time, the Friday chats that Tom Sosnoff does. Those are archived in years past, and it's a fantastic archive. I mean, I've got stuff in there in like vertical spreads. The Greeks is something we've just absolutely beaten to death in that particular archive. So I highly recommend, checking those out. Ultimately, when it comes to things like vertical spreads, for example, whether you're bullish or bearish is kind of up to you. I mean, that's something no matter how many people, you're going to call, whether you're bullish or bearish is up to you. Now, how to actually set up the spread is something that, we can help you with in terms of criteria, or I can help you with right now. And when you go to criteria, try to sell an option or spread that's got, usually more than about 30 days to go to expiration. If you are selling spreads, look for a delta to sell between about a 30 to 40 delta. That is, if you sell an option with around a 30 to 40 delta, that basically gives you anywhere from a 60 to 70% probability that the option that you're selling is going to expire worthless. So I'm on the spiders right now. If I was bearish on the spiders, you look at July. July's got 24 days left, not too exciting to sell, so I can actually bounce all the way out to August. Got 59 days left, plenty of time. I look at like the 132 calls. You just right-click on those, go up to sell, down a vertical. You could do a $1 wide vertical, $2 wide vertical. I mean, it's ideal. And that's basically if you wanted to sell a vertical spread. You can also buy spreads. Buying spreads has lower probabilities associated with it, but it's basically just getting that methodology down. Now, when it comes to the Greeks, the rabbit hole in the Greeks gets a little bit deeper. So, have you traded any verticals yet, there, Mike?
No, I haven't. I've long options and put options with some success over the years, and stocks as well. But the verticals are Greek to me.
Yeah, what's interesting about that, so when you're first learning verticals, back away a little bit from the Greeks. And I'm a guy that, listen, I absolutely love Greeks. I'm all about it. You should definitely understand the Greeks. When you're first getting into vertical spreads, there's two primary strategies, actually, that you want to focus on. You really want to focus on everything you can find out about vertical spreads and everything you can find out about calendar spreads. That's it. You know, if it's a diagonal, it's just a vertical spread mixed with a calendar spread. You've heard of trades called like iron condors. Iron condor is just two vertical spreads. So the vertical, okay, and the calendar are your building blocks. From there, then you worry a little bit more about the Greeks. And the reason is the Greeks are fantastic, and it's a tool that takes you to the next level. But the reality is, until you are routing multiple trades and actually managing multiple option positions, the Greeks don't do you that much. I mean, if you just go out and sell like a 132, 134 spread in the spiders, you might as well just sit and watch that one spread, learn how the option cycle works. When it comes to the Greeks are really telling you what your position is doing right now, but it's also kind of giving you insight into what the position is going to do into the future. And that's, a little bit more, hopefully I give you a little bit of insight into to what to look at initially on some of your positions.
All right. Thank you, Don. I'll call you next week.
All right. Sounds good. Thanks a lot, Mike. Appreciate it. So we're going to jump to a next caller here in just a second. But, hey, if you guys have got questions about verticals, about calendars, about anything, give us a call, 877-927-6648. Usually people are calling up asking about how to set up trades on individual stocks. It makes it more interesting for us. You know what it is? On days where the market's up big, everybody's like, I'm finally making money. I don't need you. So you guys have tendency to call me much more on big down days like last week. That got exciting a little bit. Anyway, with that, I'm going to jump to the next caller. We got Mike in San Diego who's got a question about gamma scalping. You there, Mike?
Yes, Don.
Yeah, how you doing?
I heard you talk about gamma scalping in the past, and I understand what gamma is, but I don't understand what the term gamma scalping means.
All right, I'm going to give you the good, the bad, and the ugly about this, and hopefully it sheds some light on ultimately what gamma scalping is really about. First of all, gamma. I'll explain gamma and then gamma scalping here. Gamma scalping, first of all, is a strategy that's been used primarily by market makers, and now a lot of retail clients are utilizing it. The strategy, itself is surrounding gamma, and gamma, of course, is the rate of change of delta. So delta is, how much the option is going to move for every dollar move in the underlying. And everybody's heard that definition. So again, delta is the rate of change of the option for every dollar move in the stock. Gamma is the speed at which delta is going to move. Now, what it really effectively does, gamma scalping, is typically done on what they call a delta neutral position. And you're literally scalping shares of stock and or options against, for instance, a straddle. So if you looked at a straddle, and this is where, and again, I don't know your level of experience here, but this is where things get a little bit complicated whenever I explain gamma scalping. So you okay talking about gamma in this? Go ahead.
Well, I understand a straddle, yes.
Okay. So if you buy, for instance, an at-the-money straddle, an at-the-money straddle would actually be a delta neutral position because you're buying, in, like, for instance, 10 calls at the money, 10 puts at the money, and that actually neutralizes it. So for the most part, at that point, you'd want the market to move up or down. So if the market were to move up, for example, the calls actually appreciate, the puts depreciate. What gamma scalping does is it takes advantage of small moves in an underlying, either up or down, and after that small move happens, you actually lock in the profits. For instance, if the market were to rally just a little bit on your straddle, what you do is lock in the profits, by going back to delta neutral. So if the straddle starts to appreciate on the call side, literally what that does is it changes your delta. And it changes your delta by a rate of how fast the gamma is moving, and you can actually literally lock in some profitability by going back to delta neutral. Now, the reality is of this, there's a couple things going against you. If you buy a straddle, you've got time decay going against you. Number two, every time that you try to lock in profits when you're gamma scalping, that actually costs you quite a bit of commissions. And it's becoming more effective to do the idea of gamma scalping as a retail client only because transaction costs are definitely down. They're down more than they have been, historically. the efficiency of the marketplace is making this, a decent strategy. But the reality is I still have a problem with gamma scalping because you're buying a straddle and time decay can really crush you. So ultimately what you would want is if you were gamma scalping, you want that underlying stock not just massively move in one direction or the other like you would with a straddle. If you go out and gamma scalp, you want a stock that's actually moving back and forth like, for instance, like a pinball machine. Literally, up a couple dollars, down a couple of dollars, up a couple dollars, down a couple of dollars. And the reality is, in today's volatility climate, I'm not sure you're going to get that. So I've seen a lot of guys now doing what's called a reverse gamma scalping, which is they start with selling a straddle or selling, a form of a straddle like in some defined risk, and then scalping chunks off of that as they go. And this is well documented stuff. So, there's books you can go out and buy on gamma.
Wouldn't you, as you're gaining on one side, like the call side, wouldn't you be losing on the put side?
Yeah, theoretically you are, but you're not losing as much, and the reason is this. If you take a 50 delta call and a 50 delta put, and the market starts to rally on the 50 delta call, the 50 delta call goes in the money. It jumps, for instance, to a 60 delta, whereas the put actually drops out of the money, okay? And when the put drops out of the money, the deltas don't drop off quite as substantially. So an in-the-money option gains, for instance, if you had a 70 delta option on the call side and you only had a 30 delta option on the put side, all right, and we rallied up, obviously you're going to gain more on the call than you're going to lose on the put. That make sense?
I see.
Yeah.
Could
so
I
it's, go ahead, fire away.
Could I ask another question?
Sure, fire away.
There's a term on certain trading platforms called the total view, and I'm wondering if you've heard of it, and if so, what's the plans for at the ThinkorSwim for it?
All right, recite what you said there again. The what view?
There's a trader called there's a guy named Fasco that you might have heard of.
I know him really well.
Yeah, he was interviewed by Tom a lot. Anyway,
sure.
he talks about a feature on a trading platform called Total View, which apparently is like level 2 on steroids.
Sure.
And I'm just wondering if the ThinkorSwim is going to adopt that feature sometime in the future.
The reality is, so when it comes to, first of all, I'll give you a little background on there. I actually know Fausto for years and years. We have, for the most part, what a total view is it's NASDAQ level 2, and it's looking at several different levels of NASDAQ level 2. Ultimately, we have it on here. You have to request it, though, okay, meaning that we give you a version of NASDAQ level 2 when you have ThinkorSwim. We can open up the full-blown view of NASDAQ level 2 to you. If you shoot an email to us, we'll open it up and you can see the full NASDAQ level 2. We don't do it for everybody because it ties up a lot of bandwidth. The way it's laid out, though, is different than Fausto would use. So you have to dig a little bit deeper in ThinkorSwim. We also, in addition to having the level 2, we also have time and sales side by side with that. So it's just, the reality is it's just displayed differently is what it comes down to. The data is all there, but you just have to dig a little bit deeper in ThinkorSwim. I personally, I'm not a NASDAQ level 2 guy. And I'm going to give you some insight to NASDAQ level 2 and I don't want to disparage anything that anybody does out there. I know exactly what Fausto does. He's a contrarian against NASDAQ level 2. But I want to talk to you a little bit about it. And the reason is this. Several years ago, most market makers have gone completely algorithmic. And that simply means when you're looking at stock trades going through, you're not looking at a person saying like, hey, I want to sell 50,000 shares. And this is worth talking about, too, because so many people listening right now have no idea what really drives markets anymore. But nobody goes out there that, for instance, you're a market maker and you want to unload 50,000 shares. You don't say I want to unload 50,000 shares and literally put that in a book because everybody looks at it. I mean, literally, everybody can look at it. I can look at NASDAQ level 2, which means every other derivatives firm on the planet can look at NASDAQ level 2. So what they literally can do is, they could be trying to buy that stock. They could be, bidding for it when in the reality is they're offering it at the exact same time. So when I say things are algorithmic out there, everybody today wants to be small, anonymous, and not show any size whatsoever. There's also like algorithms out there, and these are just literally trading equations that go out and do what's called spray the markets. So if I was a big trader and I wanted to unload, for example, 100,000 shares of some stock, like Apple, for example, I want to unload 100,000 shares. Everybody's going to be able to see that. So they have ability to, for example, type in to their trading platform that I want to sell 100,000 shares. I want to do it in the next 10 minutes. And they have an algorithm called a VWAP spray. What a VWAP is a volume price weighted average. They'll put in one price they want to sell at, and literally the algorithm goes out and sells in, for instance, batches of 100 shares at a clip. Over the next 10 minutes, it'll actually spray to multiple exchanges simultaneously. And it's interesting to see that right now because there's still a lot of clients out there that are messing with NASDAQ, level 2, and so forth. And I think that has become a little bit too efficient for looking at some of those, secondary markets like a NASDAQ level 2 quote, only because, listen, everybody in the industry by now, they realize exactly that you're looking at that. And 10 years ago, it absolutely worked. But in today's marketplace, you're just trading against Sun servers and IBM servers out there today. There's not a lot of people sitting behind there.
Okay.
So hopefully that didn't freak you out too much.
Yeah, no, that I think I followed that pretty well. So what you're saying is that his idea of looking at support and resistance using what he calls total view is really not going to really help that much.
It can to some degree. I mean, what I'm saying that is there could be retail orders in the book, meaning that there's a lot of retail customers out there that post orders in a book. But, for instance, like a stop order today, we don't route stop orders to the exchange. So when we have a stop order, we keep it internal at the server, and we fire when that particular contingency is hit. Now, the reality is when it comes to things like stop orders, some people may actually post them out there on the marketplace. It depends on the different broker-dealer.
So you're saying the big players really, let's just say, are able to defeat level 2.
Yeah, I'm going to go a step further. The big players, when you mention a big trader, traders now, the really big ones, they trade dark. So dark liquidity, and that's something that's, that's one that you could definitely Google out there if you guys are listening, because I don't want to go into the 45-minute, speech about what dark liquidity is. But there's crossing networks now. For instance, if one mutual fund wants to sell 1 million shares of Microsoft, what they actually do is can post that trade literally in a crossing network. They say, I just want to sell, for instance, 1 million shares of Microsoft. Another firm comes by, they see that posted up there, they agree upon a price, and they cross that order, and then they have to actually print that order to the exchanges. For time and sales within, I want to say it's about 30 to 90 seconds. I can't remember the exact time frame. But dark liquidity is becoming bigger and bigger, and there's what they call dark pools. There's tons of dark pools of liquidity, and that's pretty much from bank to bank out there. The interesting thing is a lot of retail clients, they complain about that, but the reality is this. Do you really want somebody that's not, a big-time trader out there selling 1 million shares? It would cause so much short-term volatility if everybody had to trade in the open marketplace, but they still have to print those particular orders thereafter. And it happens nonstop. Like, literally, you'll be looking at the liquidity on the spiders throughout the day, and it's trading like 106 million shares today. All of a sudden, you're like, oh, it's 108 million. Well, there was some type of a cross out there of 1 million-plus shares. And it happens, again, nonstop, and that's where the biggest trades are done. One other thing that I always mention is you can type in, for instance, like Apple on here, and I don't know if you're looking at a screen show with me or not, but for instance, I'll type in Apple and pop that up, and I'll come over and I will take a look at Apple and I will look at time and sales. Do you ever take time and look at time and sales in here?
Yeah, I do sometimes.
So I'm not that big in time and sales, but one really interesting thing about it, and I got to pop Apple into time and sales here. One interesting thing about it is take a look at the size of the trades that are going through in time and sales. So I've got on my screen show right now, I've got Apple up, and I'm looking at time and sales, and it's ripping through real time. And all you see is 100, 100, 100, 100, 100, 100. That's totally algorithmic trading, meaning that that's just computers that are basically generating orders to keep Apple in line with, for instance, the NASDAQ futures. As the NASDAQ futures move, it drives order flow to Apple. and people are always looking like, oh, where's the retail customers? You can always tell retail customers because, for instance, I just saw some time and sales that went through for 150 shares. Algorithmic trading can only be done in round lots. They can trade 100, 200, 300, so in lots of 100, where a retail customer can trade odd lots. For instance, I see 170 shares that just ripped through. So it's actually really interesting to take a look at that. And again, I don't really use time and sales on a day-to-day basis. I believe the markets are relatively efficient today, and ultimately anybody that has size is going to hide size. I mean, that's the name of the game. You can also filter your level 2 here your time and sales here on ThinkorSwim. You can filter it by size of the trade. So I'm looking for any trade greater than 5,000 shares. There hasn't been one. All right, so greater than 1,000 shares, and there's very few big trades that are done out there. So keep that in mind when you're trading on a day-to-day basis. Keep your eye on the futures, though. Futures, again, are driving order flow today because as those futures move, all right, literally statistical arbitrage takes place and drives order flow in the futures will then drive trades in individual stocks. And what that is for the most part, servers all over the world are tied definitively to what those futures are doing. So as the future moves, for instance, the S&P 500 future, the underlying 500 stocks have to move in tandem for the most part with what the futures are doing.
Okay, right.
So hopefully I didn't totally blow your mind over there, but it's stuff that as technology really starts to come into play in the marketplace more and more, which it already has, it's important for us, not only in the brokerage industry, just the trading industry, to try to keep you guys kind of in the know about what's going on the professional side of the business as well.
Well, very good. Thanks for answering my questions.
All right, Mike. Appreciate you giving us a call.
Okay, Don. Bye.
All right, thanks again. So, I gave Mike there the long and drawn out answer, both on gamma scalping and, of course, on taking a look at like Nasdaq Level 2. And I got to say, I'm not the biggest advocate of Nasdaq Level 2. I like to make things a lot more simple than most people. I got guys out there that are like looking at every chart and every technical study and kind of trying to come up with reasons. I mean, listen, Apple right now, the price is $324.90. Why? Because it is what it is. Order flow says it's $325. It's relatively efficient. There's millions and millions of shares trading hands out there right now. You got to sometimes back away, and there is no rhyme or reason, okay, for sometimes the moves in specific underlyings. I mean, yeah, you can come up and like I was hypothesizing here earlier that the bonds are not trading down very much because Bernanke's going to speak tomorrow, but that's, it's reality. That's what order flow is actually saying in here. Anyway, with that, if you would like, you should give us a call. The number here, 877-927-6648. We got plenty of room for more callers to talk about stocks, options, futures. Or if you guys want to follow up on some of the questions over there, if you got somebody in here that does look at NASDAQ Level 2 and uses it on a day-to-day basis, I'd love to hear from you because literally there's tools that we build into the software that I might not be utilizing on a day-to-day basis, but I'm curious if they help you. So give us a call. Let us know. I'm going to jump to the next caller. It's Kevin in New Jersey. He's got a question about weeklies. You there, Kevin?
Yeah, how you doing, Don?
Hey, sorry to keep you holding there, man.
That's okay. My question is on the weeklies, vertical spreads.
Yeah.
Is that recommended or is that not? And should they be 1 or 2 calls, strikes out of the money?
Sure. So vertical spreads are fine in weeklies. The only thing is some of the products that have weeklies on them are like $20 stocks. It's kind of hard to get a vertical off. But when you look like an Apple, Apple's got plenty of room to be able to do weeklies on spiders, weeklies. You could do verticals on there. So you're looking at spiders?
Yeah, spiders would be. What I wanted to do is, I guess it'd be more or less like an iron condor, where I could do some further out, 2-3 months out in call spreads and put spreads.
Sure.
Bearish and bullish, would have them at least 2 strikes out of the money because the premium's paying pretty good. Apparently, it looks like.
It's not half bad in these weeklies right now. So volatility just in the last couple of trading days, and really over the last 5-6 trading days, vol has picked up a little bit. I mean, yeah, volatility is down today. I mean, the VIX is down like $1.35 today, but regardless, vol is still better than it was a couple of months ago, where it was sitting at 15%. Anyway, yeah, no, you know what? Verticals, irons will definitely play out in the weeklies. The thing that you got to realize is this. When you put on something like an iron condor in a weekly, there's no fix for it. I mean, basically, you're in it for better or for worse. And ultimately, when they go against you, you got to remember this. During the life of that trade, it's going to look bad, meaning that, you know, today you put on the trade, it looks great. We rally up $2 tomorrow. You're like, oh, no. We're down $3 the next day. You're like, oh, no. You know, it's always going to be that back and forth. The thing with the iron condor is you're going to hate the trade and you're going to hate yourself until that thing is closed. And that's one of the most difficult things about irons is when you have them on for a month, yeah, you're sweating it out a little bit, but you got a little bit more time. You're a little further out of the money. On the weeklies, it's like the emotional roller coaster from hell. I mean, literally, you're holding this thing, and you're just like, holy crap, and you're getting killed to the upside. 2 days later, like, holy crap, and you're getting killed on the put side. It's, man, they should make medication for that because I've actually traded a couple of these irons on the weeklies myself, and it's a bit of a roller coaster ride. So just you got to keep that in mind, stick to your guns, and you got to allocate really small, though, in the weeklies because the pressure of that trade going against you cracks a lot of people, and they snap out early.
So weekly verticals are fine then?
Yeah, absolutely.
The reason I asked that is because you had said that you would want us out 3 or 4 days prior to expiration because of the gamma's effect on delta.
That's exactly why I was. That's exactly why I was saying a moment ago. I'm like, you're in it for better or for worse. See, at least on a monthly, you've got a little bit of management time in there, but you want to get out a couple days before expiration. When it comes to a weekly, you're opening the trade in the middle of that gamma explosion. There's nothing you can do about it. You're just basically taking a short-term bet that iron is going to pay off.
Well, the benefit is that you have so much theta deteriorating to your favor.
That's true.
I mean, that's a positive. I mean, if it doesn't move much.
Proportionally, theta, gamma actually grows larger, meaning that your gamma is proportionally larger, and that is negative gamma. When you sell options, you produce negative gamma. The negative gamma is proportionally larger than the theta would be. So if you're collecting, for instance, $20 a day or something on decay, the gamma will start to explode even larger than that. I mean, the bottom line is this. Gamma doesn't really matter if you just have that one trade on, because if you have that one trade on, you know what the profit and loss is going to be. If you've got, a $2 wide iron condor in a weekly, and you got $1.30 of risk or something like that, you sold an iron condor for 70 cents, you got $1.30 of risk and a $2 wide iron, all hell breaks loose, you lose $1.30. And as long as you're comfortable with that $1.30 of risk, it's fine. But there's no real way to fix trades in that weekly expiration. Right. If you think you're going to get assigned, though, I would actually close out those trades. Don't let the assignment happen on the weekly. It's probably easier to bail out because the assignments, of course, have got fees associated with that and such.
So just keep small trades until you get used to it. I've never done them yet in weeklies, but
it's always an interesting one. I mean, I'll tell you this: when it comes to weeklies and iron condors and verticals, I don't make that like kind of my staple trades. I make that part of kind of my portfolio, or I do it on the side, and there's weeks that I do it, and there's weeks I don't do it. And it's just basically my feeling, like, hey, I think we're going to be relatively stable this week, I'll sell an iron condor. If I think we're going to be rocking this week, there's some big news out, I might be a little bit more hesitant. Obviously, like tomorrow, Bernanke's coming out. He's gonna speak. Is anybody going to listen is the real question. That could
go either way.
Yeah, it could go either way, and that's the kind of thing that can kill an iron condor. But all of that tension surrounding something could also mean nothing. You know what actually always gets me is it's some crappy little news report that everybody knows is coming out, like an unemployment report. It's coming out, and it comes out all the time, but all of a sudden one that misses really big or hits really big, those kill you on irons, especially on the weeklies, because, like all of a sudden on a Friday morning you're like, oh, yeah, I'm going to get out of my iron today and make some money, and on a Friday morning we explode to the upside, and you're like, oh, here goes that one. And I've had that happen to me.
I want to ask one more question. I just got a tweet, Dr. J. I'm sure you know who that is.
Sure, I've known John for years.
Okay, the VIX, he said that the VIX pulled back down to 18 in the last couple hours. He has a July 19. He says futures look like July 1950, August 2045, September 2180, and October 2260. Where is he getting that at? I'm on ThinkorSwim platform, and I can't find that. Where's that at?
Oh, he's giving projections of where he thinks the market's going to be? Is that what you're telling me?
I don't know. Is there a futures area that would tell that, or is nothing that tells that, right?
No, he's just giving levels of where he thinks we're going to be. I mean, that sounds just like his judgment call out there.
That sounds like the market's. We got some turbulence ahead. It sounds like.
Yeah, the reality is this though. Can you even project where we're going to be tomorrow? Because I can't. I got to tell you. So right now, my own personal feeling of the markets right now, I usually have a good bias in one direction or the other. And there's times where my market calls I'm hot, and there's times where I'm so cold I can't find the front door of my own house. And that's the way traders go. You're either hot or you're cold and picking market direction. Right now, though, I personally believe that we're at this inflection point in the marketplace. And with that, we all know that we're oversold from the last couple of weeks. We've had 3 days of a rally here right now. The VIX, though, just literally backed. It actually rallied back up a little bit. When I say we're at an inflection point, we could explode to the upside here and, in that oversold situation, rally back up a little bit. But we could also continue to crumble. And I got to tell you, I can't even pick where we're going to be tomorrow, much less a month, 2 months, even 3 months from now. When I look out into the future, I want to be bullish. I mean, I do. There's nowhere to put your money right now, so I got to be bullish into the future. But the reality is this: again, with this kind of inflection point here, we don't really know not only what the Fed is going to do, but are they going to raise the debt ceiling? There's too much political crap out there right now for me to even give a clean judgment call a couple of days from now. I love the idea that guys write newsletters, but again, I can't pick it tomorrow versus 3 months from now. But it's tough.
When you see the best stock out there, pretty much Apple going from 370 down to 315, it sort of makes you really, want to sit on the sidelines.
You know what, though? That's the kind of trading that I like, because ultimately, I went from 370 to 315, but that kind of trade, there's at least some two-way action in there. And that's always one of my reasons. I'm not a big equity guy. I'll look at Apple and I look at Google because I do, this show and a lot of other, talking engagements all over the country. But the reality is I'm a big index guy. Again, I have trouble picking the index products right now, much less individual stocks. These stocks are moving in tandem right now with the index products. So it just drives me right back to, hey, use the damn spider, use the S&P futures out there. It's an easier, gentler world because, to be honest, Apple, do I track it? I love their products. I mean, I've got my Mac-issued underwear on right now, but the reality is I have no idea where that stock is going because it's literally the stock is completely decoupled from the products in that company. I mean, to some degree, sure. I'm sure Apple trades off of its earnings and off of information coming out, but on a day-to-day basis, I mean, did Apple do something spectacular versus yesterday because it's up $10 today? I mean, it doesn't really matter, on a day-to-day basis, and that's the scary, portion of trading.
Well, right now, the way the market's going, even the weekly spiders is what I want to trade. And it's more or less like rolling the dice and closing your eyes for 4 or 5 days, I guess.
Yeah. Oh, yeah. For weeklies, it is. Weeklies are exciting. I like them. I mean, one of the things I like most in the weeklies, though, is the ability. I like selling covered calls. So I own a couple of underlyings out there, and I actually bang out covered calls on a weekly basis versus a monthly basis. Reap the benefits of statistical benefits of decay. It's that much better in that weekly product. It's good stuff.
Are you doing covered calls on the spider or on equity?
I've actually got it on the spiders. I also I happen to own some products like TBT. By the way, TBT is a horrible thing to own. I don't recommend it, and it's got weeklies as well. But the premium sucks in there right now. I'm just getting killed trying to sell premium against that, so I don't really recommend it.
It's pretty safe. It would probably be pretty safe to if I wanted to play the spider in the money September. Buy some calls and sell some, I guess even weeklies against it. That would probably be to my advantage, I guess, right now, if we're going to have a bull market.
Sure.
Hopefully.
I'm not a big call buyer. I mean, you can buy in the money calls, but if you were bullish right now on the spiders, you could also just buy the S&P futures. So I'm going to have to jump to another caller here right now. I got a couple of people holding, but Kevin, I appreciate the call. Yeah, thank you.
Thanks very much. Okay.
All right. Yeah, thanks again. So with that, I'm going to jump to another caller, but we've got plenty of time here. If you guys want to give us a call, the number is 877-927-6648. Give us a call. Talk to us about your trades out there. We've talked about everything today from gamma scalping to NASDAQ level 2 to the weekly options out there. Verticals and Greeks. It's been an interesting day so far. Next, we're going to jump to Richard in California. He's got a question about probability of expiring. You there, Richard?
Yeah, I'm here, Don.
Oh, man,
so
I've been keeping you... Sorry, I've been keeping you holding forever there. Go ahead.
That's okay. On the TOS platform, when you go into the options section, you can look at probability of touching.
Yeah.
And the question I have is why, if, on any given strike, why is the probability of touching different between the call and the put for the same strike?
Oh, that's a really easy answer. It's okay. So when we solve for probability of expiring and probability of touching, on the trade tab we utilize the individual options implied volatility. Okay, meaning that on the trade tab itself we use the individual option implied volatility, whereas over in the analyze tab we use a VIX style centralized implied volatility. So it's basically one implied volatility over in the Analyze tab, but in the Trade tab we use a unique individual implied volatility for each unique option. Now, what's different about the calls or the puts is what we call the implied skew. So if you switch your information layout from probability of touching and go over to, for instance, to implied vol, what you'll see is the individual implied volatility of each unique option, and you'll see quite a big skew between the calls and the puts. And that skew is basically caused by order flow. So, for instance, the 125 puts are trading right now for almost a 19.5 vol, whereas the 134 calls are trading for a 13.5 vol. Okay, so basically what are you getting? The puts are more expensive than the calls, and the reality is that's because people buy puts as insurance and sell calls, and they're selling those calls to help cover the cost of some of that insurance they're buying. The real reality is markets crash down, not up. And that has an effect on, of course, the probability of touching and probability of expiring calculations.
Okay.
You're right over there, because usually when I rip all that stuff out, I can give you the math behind it too, which is a really scary thing. But no, I mean it's that easy. But you know what? If you want to be deadly accurate about your probability of touching, you can go to the Analyze tab and you can switch over the probability curve in the Analyze tab literally to probability analysis and switch it to probability of touching. And you can get, but it's I mean, we're talking like such a minute thing. You know, the only guys that ever do that. Are you an engineer or a former engineer?
No, I just was curious when I saw the difference.
No problem, man.
The other quick question I have is, can you say anything about why would you choose to do a calendar spread with puts as opposed to calls? Why would you choose one versus the other on a calendar spread?
All right, are you trying to be directional on an equity, or are you trying to do it in an index? Because it makes a big difference.
Well, can you speak to both of those?
Okay, so I will. To me, there's a very big difference between trading calendar spreads in equities versus trading calendar spreads in index products. And I'll start with the index products, okay? And the reason is you kind of get this as we go along. An index products like the spiders, when the spiders rally up, inherently volatility would back off. Volatility goes down. Conversely, if the spiders were to sell off big, for instance, today, the volatility goes up. Calendar spreads are ultimately very sensitive to changes in implied volatility, in that calendar spreads are net long vega, they're net long volatility. So increases in volatility help calendar spreads. Now, if you go out, for instance, the spiders right now are trading at 129.20. If you went out and bought a 133 call calendar spread, anytime you buy a calendar spread, the calendar spread itself is the target, meaning that if I buy a 133 call calendar, I sell July, for instance, by August, I'd want, by July expiration, the market to trade from 129, where it is right now, to 133. But if the market rallies to 133, the volatility will most likely drop off, and it actually injures the calendar spread very slightly. Like, you'll probably still make some money on it, but the fact that we're rallying literally contracts volatility and hurts the calendar spread, the call calendar spread especially. Now, If you look at the other side of that, if I put on a 126 put calendar, and that is selling the July 126s, buying the August 126s, if the market were to sell off considerably to 126, that's not too considerably, it's $3, whatever. But if the market were to sell off, volatility picks up a little bit, and as vol picks up, it actually puffs up and expands out the back month August option, and there you actually are literally gaining profitability based on an expansion in volatility. Now that's why the put calendar spread is typically the way to go in an index product, for instance, like the spiders, the IWM, the Qs, et cetera, et cetera, et cetera. But when you go into like an Apple or something, you want to trade like an equity, doesn't matter. You want to do a call calendar spread in Apple, go for it, because volatility doesn't necessarily contract in these equities like it does the index products, meaning that Apple sometimes, when it rallies, literally volatility can expand in Apple once in a while during a rally. So, again, the way to look at calendar spreads is very different in an equity versus an index product. You okay? You got any follow-up on that one? Because, I just unleashed upon you quite a bit of stuff.
No, it's great. It's exactly what I needed. Thanks a lot, and I'll let you go to the next guy.
Yeah, no, there isn't a next guy. So if you got a follow-up question, fire away. You're it, man.
Okay, yeah.
You've only got like a minute or two, but go for it.
All right, I got one. So I sold a naked put on Priceline. Priceline then just crashed. This is like 2 weeks ago. Okay,
yeah.
So I was in big trouble on the naked put. So then what I was trying to do is figure out what to do, and I realized that if I rolled this put to a longer term naked put, I would actually get, and I could even drop the strike price way down, and I would come out with it for a credit. So why it seemed to me like a no-brainer. I'm getting out of like a $2,000 loss, taking in a little bit of money now, and letting this thing ride for 6 more months. So what was I overlooking? It couldn't be that good, could it?
Well, can I ask you which puts did you sell?
Okay, I think I owned like I'm not sure. I think I had like the 465s. I sold the 465s.
Okay.
Then I rolled those to selling like the October 425s.
Right. Okay. So you rolled them out a little bit. The one thing is, and first of all, when you sell naked puts in Priceline, this stock's up $25 today. This is a wild ride over here. There's no question. So Priceline obviously is, it's almost a $500 stock with a 34% implied volatility. This gets serious in here. The one thing I always tell people about whenever you sell naked puts, you got to be willing to get put the stock. Okay, meaning that if you're going to take some heat, you just got to be willing to get put stock if you're ever going to sell naked puts. Otherwise, use a put spread and take your lumps if they go against you and bail out. Because
that's exactly the idea. I thought when Priceline was at 500, I was like, heck, I'll sell a naked put for 465. I'd love to have it there. But by the time it crashed right through that, and it was down in the 440s, if I'm not mistaken. So It didn't look as good at the time where I would have actually got put the stock.
I mean, so if it was me, I'll roll, for instance, for July. I'd probably roll right to August. I wouldn't jump to October because in October you got so much time, 122 days. The decay is not that great, but a lot of bad things can happen to you between now and October. So I don't like the risk inherently in that trade necessarily, because ultimately at this point you're not collecting a huge amount of decay, but you're still taking that long stock risk. I would be more likely to roll from July to August, and I know that you'd probably be rolling and have to use like an at-the-money option in August, which could actually put you at more risk. So you got to determine, do I still want to own this stock? Because selling that put is basically getting long the stock for the most part. And if I do, then I'm not scared of selling like an August at-the-money put. And that's ultimately it. That's kind of the way to look at it. Whenever you sell options, though, try to stay shorter dated. I mean, literally, the most I ever go out is, 60, 70 days at most when I'm selling premium there. And keep your time short because you want to keep the decay pouring in for yourself.
Okay. Thanks a lot, Don.
All right, man, no problem. And sorry you got tagged on Priceline, man. That is a wild ride. Up $25 today, though. It's got to be helping you big.
Yeah, it was great.
Yeah. All right. Thanks a lot. So we'll give you guys kind of a quick recap of the market, kind of wrap up the day. Somebody was asking about RIM over here, and you know what? I'm going to give you guys 2-minute synopsis of RIM. If you take a look at RIM is back up almost $2 on the day. RIM did get smacked down in its last earnings announcement here, kind of surprised everybody and really blew through ultimately the what we call the market maker move. I think shocked quite a few people. So the August 25 puts that was being discussed there, Steve over in the chat room there, the August 25 puts, you should be fine right now. I mean, this is a pretty good size rally. Obviously, RIM is a little bit oversold. It's kind of bouncing off those along with the rest of the NASDAQ today. But yeah, the August 25 puts, you know, you're fine, you're clean. And listen, if you don't want to get put the stock at 25, buy back those puts and bail out of the trade. Again, anytime you guys sell naked puts, be sure you want to be able to get long that stock. With that, 2-second synopsis there of RIM. And again, RIM surprised everybody. In fact, I was with Tom Sosnoff last week. Oh, he was getting annihilated in RIM just to make you guys feel better. You know, I think I saw Tom shed a couple of tears. It was good stuff. S&P futures up 13.25. NASDAQ futures up 38. Haven't moved much since we started this session about an hour ago. The VIX is actually rallying back up very slightly, down about $1.21. It was down almost $2 earlier in the day. With that, bonds now are completely flat on the day, something to keep an eye on, because if you actually look at the bonds themselves, the bond futures, they've actually ticked up, which means they could be posturing in a defensive position for Bernanke's little speech tomorrow. Could be interesting. With that, of course, I will be back next week live from Scottsdale, Arizona. This is Don Kaufman on the Options Hour. Again, join me every Tuesday at 1 p.m. Eastern Standard Time. Thank you guys very much for joining me today. Have a great rest of the week. Thanks a lot, everybody, and bye-bye.